This is the third update to my free DCF model. So if you want the most updated version, just email me. My email is down here. I'm going to walk you through the steps to set it up. You only need to change the data in green. These boxes are required. These are optional. I'll show you in a little bit. Let's pick a ticker, Meta. If you type in a ticker, META, and it pops up over here, you put in today's date equals today, parentheses, and the date pops up here. Always keep exchange rate at 1 unless you're doing a foreign stock. Now you just got to fill in the market cap. Let's go to Yahoo Finance. So type in Meta. It's 1.4 trillion. So make sure you enter the entire number. 14000000000. It looks like 1.4 million. It's actually 1.4 trillion because all numbers are millions except the stock price and percents. It's just formatting. Next, stock price. So go back to Yahoo Finance, 554 spot 4, and paste that in here. Now the trailing 12-month revenue or the most recent revenue. Go back to Yahoo Finance, go to Financials, go to the income statement, and it's 156.2 billion. Yahoo Finance numbers are in thousands. You see right here, thousands. So just paste that number and add 3 zeros. So that's 156.2 billion. Prior year revenue, 134.9 billion. Just copy it and paste it and add 3 zeros. The terminal value growth is what you project the free cash flows to be into the future. Since my model projects 4 years of free cash flow, then all free cash flows after year 4. I usually put 2.5%. Sometimes I go lower, even 0, sometimes negative. But for a good company, I'll put 2.5%. Now the WACC. Go to Finbox, finbox.com, search Meta. Then you click on Models. Scroll down to Cost of Capital. Click View. The WACC is from 8.8 to 9.8. I like to choose the middle one, but if you want to be conservative, choose the higher one. The higher the WACC, the lower your valuation. So we'll choose 9.3%. We'll copy that. Now we need the trailing 12-month free cash flow, or the most recent 12 months. We'll go back to Yahoo Finance, go to the financial section, go to cash flow, and on the bottom is free cash flow, 52.1 billion. You can go to other websites. I just use Yahoo Finance. You paste that in, add 3 zeros. Our calculated stock price is $487.50. It's trading at $554, so it's trading at a 14% premium. It's a sell according to the model. If it's overvalued, it's red. That means it's a sell, do not buy. Let me lower the WACC to 6. Now it's undervalued. Now it's blue. It's a buy. The way I forecast the future free cash flows, I first forecast their future revenue. So I project next year's revenue, 2025, to be 181 billion. How did I get that? I took the most recent revenue, 156 billion, and I grew it by 15.8%. Why did I pick 15.8? Because if you look into this formula, that's how much their revenue grew from last year to this year. Last year, their revenue was 134.9 billion, and it grew 15.8% to 156.2 billion. That's how I got 2025 revenue. 2026 revenue, same thing. I grew 2025 by 15.8%, and so on and so on. That's the first step to calculating future free cash flow. Calculate future revenue. Now we have to convert the revenue into free cash flow. How do we do that? I took the 180 billion and I multiplied it by 33.3%. And that's how I get 60.3 billion. How did I get 33.3%? Just look at the formula. Their free cash flow in the trailing 12 months, 52.1 billion. Revenue, 156.2 billion. They converted 33.3% of their revenue into free cash flow. So I assumed they would do that for the next 4 years. If for some reason you think they're going to grow more or less than 15.8%, you can just change these numbers. Say you think they're going to only grow 12% after 2025. You can put 12, 12, and 12. And now the valuation has gone down. Or you can change the free cash flow margin. If you think they're going to become more profitable in the future, you think their margins will be 40% in the future, you can change this to 40. If you think there's going to be 50, you could change that to 50. Just remember, once you hard code the number, it removes the formula. So next time you do the DCF, you have to put the formulas back. And having this tool down here will also help you with companies with negative free cash flow. Say they had negative 1 billion of free cash flow. It says the company's worth negative $24 billion, which doesn't really make sense, right? maybe they're investing a lot towards the future. So even though they're losing cash flow in 2024, maybe in 2025, you think they'll convert 10% of their revenue into free cash flow. Then their free cash flow margin will go up to 15%, then 30%, then 40%. And now the stock is really close to where they're trading at. This new DCF model gives you a little more opportunity to play around with the numbers, because most companies don't grow at the same rate forever or decline at the same rate forever. Another thing to change is the WACC. If you think the WACC is too high, you think it should be 8%, now it's undervalued. The lower the WACC, the higher the valuation. The WACC is discount rate, the rate you discount the cash flows by. So if you want this model, just email me. If you have any questions, let me know in the comments. Thanks for watching.